Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at three highly ranked stocks to consider buying in Q4 despite the growing market fears as we end September. And the three stocks we're going to look at today are NXP, Semiconductors, Textron, and Construction Partners, Inc. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we get into these three highly ranked stocks to consider buying, I want to go quickly into some of the broader market because obviously many people are a little nervous considering the wave of selling to end September, especially after that Fed meeting last week. So I want to highlight some of the moving averages we should be looking out for the S&P 500, and then maybe or also look at some earnings and interest rate data. So it looks like the S&P 500 and the NASDAQ could be approaching their 200-day moving averages, which would hopefully be a level of bullish support and maybe a line in the sand. And it looked like until we saw some buyers come in today on Thursday that we were headed for those levels pretty quickly. And with that in mind, we would see the S&P 500 and the NASDAQ both approach their most oversold RSI levels since the market, especially for the S&P 500, since the market bottomed back at the end of the third quarter and the start of the fourth quarter of 2022. And then if that 200-day moving average breaks, the next line in the sand would be shortly after that at the 50-week moving average. And then farther below that would be the 200-week moving average. And that is a moving average that's only been broken below really once during the last decade, and that was during the COVID-19 crash. So those are some lines in the sand we should be all looking at in the coming days and weeks, especially as we start the fourth quarter. But despite some of the downturn in what's a historically rough month for the stock market anyways, the bears continue to talk about a so-called earnings cliff. But the most up-to-date Zacks data continues to showcase that earnings have indeed already bottomed in the second quarter, and they're looking rather impressive in terms of the growth outlook. So third quarter S&P 500 earnings are projected to dip just 1.8%, which is improved from where that was just a few months ago, and then climb back all the way to 5.3% growth in the fourth quarter. This would be following a 7.1% decline in Q2. And then if we look ahead to 2024, we're calling for S&P 500 annual earnings to grow 11.9% and then another 11.3% in 2025. So back-to-back years of 11% or higher adjusted or earnings growth on the back of 3.3% projected decline in 2023. So really solid growth, and obviously these revisions can change and the outlook can always change, but that certainly doesn't scream that the U.S. is headed into a major recession when you consider the annual earnings growth. And then on the interest rate front, even though Jay Powell and the Fed are in wait and see mode, and they said they could possibly hike at least one more time in 2023, they're just giving themselves a little bit of breathing room should they have to turn up the heat slightly more. And we should note that investors had been pricing in higher rates for longer since back in April and May, when it became obvious once again that inflation wasn't going to fade as quickly as everyone hoped, considering that the U.S. economy has remained really strong and the jobs market has remained really resilient as well. And we should note, before we go into these three stocks to consider buying in the fourth quarter, amid that September downturn, or after the September downturn, the fear/greed index are at extreme fears levels right now. So they're at the lowest levels of 2023 outside of March, when the market bottomed at the last point and then went on that big run. And the American Association of Individual Investors sentiment survey released today had the bullishness level at the lowest level since May. And the bearish level was the highest level since May as well. It's now unusually high, and the bull-bear spread is the most negative since May as well. So these are often contrarian indicators to consider buying. And overall, if you're a longer-term investor, these big pullbacks that we're seeing in the market are often opportunities to buy, because people are often most excited to buy at what will prove to be the near-term tops, and then least excited to buy what will eventually be the bottom. So with that in mind, we're going to take a look at three highly ranked Zacks stocks to consider buying at as we close out September and head into the fourth quarter. And the first stock up is Textron, which trades in the ticker TXT. So Textron operates in the broader aerospace and defense segment with a wide range of offerings in the field, as well as far more commercial segments as well. So its various units include brands such as Bell, Cessna, and Arctic Cat, and many other individual units. For instance, Arctic Cat is a leader in snowmobile and the off-road vehicle space known as side-by-sides. Meanwhile, Cessna unit is a major player in the world of private aviation for business travel and others in the non-commercial flight segment. One of Textron's segments is also attempting to push the boundaries of electric aircraft. So it's not just an aerospace and defense contractor. It has a wide portfolio as well. But on the aerospace and defense side, it landed a big, potentially huge contract with the U.S. Army in late 2022 with its Bell segment. So it landed a contract for the next generation of U.S. Army helicopters and the long-range assault helicopters. The contract, based on multiple reports, could be worth up to $80 billion over the lifetime of the contract. So that's just worth noting. The company posted an impressive beat race quarter over the summer, and Zacks estimates are calling for it to post another 8% revenue growth this year and then 6% higher next year to hit $14.7 billion, and then post adjusted earnings growth of 32% this year and then 7% next year. And its upbeat bottom line outlook helps it land a Zacks rank number 2 buy at the moment. And then over the summer, the company approved a new stock buyback program, and we should note that 6 of the 11 brokerage recommendations that Zacks has are strong buys, with the others sitting at holds. Overall, the stock is up about 190% over the last 10 years. This blows away the Zacks aerospace and defense industries just 7% climb, and the S&P 500's 162. It also includes a 35% run over the last 12 months and a 17% jump in the third quarter alone. The company is attempting to hit new highs and break out of a range that it's been stuck in for a little bit, and it's currently trading 9% below its average Zacks price target. So it's trying to break above its 52-week highs and break above a range that it's kind of been stuck in since the end of 2021 and the start of 2022. So if in the coming days and weeks it can break out of that range, it could really go on a nice run. It soared back above its 50-week moving average following that Q2 release, and now it's well above its 50-day and 200-day. And it completed that bullish golden cross in August, where the shorter dated moving average climbs back above the longer term trend line. On top of that, just in terms of price alone, and this is obviously not something most investors should consider at all times, but price is always a factor alone, just the price per share. And it trades at around $80 per share, while some other big names in the aerospace and defense field, such as Lockheed Martin and Northrop Grumman, trade at over $400 per share. So just another little note there. And despite its long-term outperformance of that segment, it trades at a roughly 24% discount at 14.2 times forward 12-month earnings. And its current valuation also represents about 10% value versus its own decade-long median and 33% below its own highs. So certainly worth considering that stock at the moment, which once again trades on the ticker TXT. And now we're going to move on to a semiconductor company, and that is NXP Semiconductors, which trades on the ticker NXPI. NXP Semiconductors is a leading chip maker with huge exposure to the automotive industry, as well as industrial market and the IoT market, as well as mobile devices, wearables, the smart home, energy segment, and beyond. So it's gaining momentum within the booming world of EVs and connected cars, and the broader electrification of the entire auto industry is going to help the company. And its various products and solutions also support the energy ecosystem. So just various segments of growth that it's going to benefit from, especially in the automotive segment. And then we should also note that Wall Street's really starting to pay attention to NXP's ability to benefit from the wider AI and machine learning revolution within self-driving vehicles, IoT, and beyond. So people are looking for any different way to play the AI and machine learning space, and NXP is certainly one that has decent amount of exposure to growth in that segment. So NXP is projected to post flat year-over-year sales in 2023 and a 12% decline in adjusted earnings, but this is coming up against 2 monster years of top and bottom line growth. And then if we look ahead, we're calling for 5% revenue growth next year to get up to about $14 billion, and then post 7% adjusted earnings growth next year as well. And we should note that it has an impressive history of bottom line beats, and its upbeat earnings outlook helps it land a Zacks rank number 2 buy right now. And then overall, in terms of its share price movement and performance, it's climbed about 400% in the last decade. This blows away the Zacks tech sector's 225%, and its highly ranked semiconductor, analog, and mixed industries 380% run. The stock's also up about 60% during the past 3 years to blow away tech at about 22, and it's still currently trading 18% below its average Zacks price target, and it's in between its 50-day and 200-day moving averages. It's also sitting on the lower end of its RSI range over the last 3 years, so that's a positive sign. And then on the valuation front, it's trading at 14.8 times forward 12-month earnings, which marks a 16% discount to its industry and 34% value to the broader Zacks tech sector, despite the long-term outperformance of both of those segments. And it's trading at 8% discount to its own 10-year median and 45% below its highs. It also pays a dividend. It's yielding about 2.1% at the moment, which is a nice bonus for a chip stock that's possibly going to be able to provide exposure not only to auto industry and many other segments, but as a little bit of an AI play as well. And in full disclosure, I will note that I recently bought NXP Semi for the Zacks Alternative Energy Innovator Service. So just wanted everyone to know that. And then on the last stock we're to look at today is Construction Partners, Inc., which trades in the ticker ROAD, ROAD. So Construction Partners ticker provides investors with pretty much the basics of the business. It is a vertically integrated civil infrastructure company. It's specializing in the construction and maintenance of roadways in various regions in the southeastern United States. So the firm's core business is currently centered around publicly funded projects such as local and state roadways, as well as interstate highways, airport runways, bridges. So tons of different areas. Beyond the public segment, it does operate a private sector where it offers paving and site work services for office and industrial parks, shopping centers, local businesses, subdivisions, things like that. So overall, it's exposed to a lot of growth in the wider infrastructure space, and it currently operates its various brands across Florida, North Carolina, South Carolina, Georgia, and more. So fast-growing areas of the United States, and it's one of the fastest-growing civil contractors in that booming region of the country, which is experiencing lots of population and economic growth. So certainly worth considering. Road posted 43% revenue growth in fiscal 2022 and 16% growth in 2021. The company topped our Q3 FY 2023 earnings revenue estimates back in August, and it raised its guidance, with its 2023 and 2024 estimates up both overall up 20% since that release to help it grab a Zacks rank number 2 buy. It's projected to then post another 20% sales growth this year and then 8% higher revenue next year to help boost its adjusted earnings by 105% this year and then another 40% next year. So big top and bottom line growth after what was already a nice stretch for Construction Partners. And then in terms of its price performance, it's climbed around 200% since its IPO in 2018. This is versus the S&P 560% run during that stretch and its industry's 53% climb. The stock's also up about 37% year to date, and it's trading above its 50-day and 200-day moving averages, yet it's still trading 10% below its own highs and 4% under its average Zacks price target at around $36 per share. Construction Partners stock has chopped around a decent amount, and it's somewhat lower volume. It's trading around 300,000 shares per day, about 292,000 on average. But it is part of a highly ranked Zacks industry. It's sitting in the top 11% at the moment, and it boasts a pretty sturdy balance sheet. And then in terms of valuation, it's trading right at its 5-year median at about 31.5 times forward earnings and 53% below its own highs. So overall, Construction Partners, which trades on the ticker ROAD, certainly worth considering as the U.S. is finally focused on infrastructure spending after years of neglect. And this company specifically is operating in growth markets that are going to seemingly continue to boom for a while as more and more people look to move to that part of the country. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.